In this video we are going to talk about dividend stocks that pay while you sleep. So before starting this video, please like this video and subscribe to this channel for our future updates. It is possible to argue that a dividend that is both paid and increased is the best kind of dividend possible. There aren't many nicer feelings for an investor than knowing that their investments are putting money in their pockets while they sleep, and that they are providing them an annual increase. How can we locate these dependable businesses that allow us to sleep soundly at night while we are associated with them? Let's take a look at the structure of a dividend stock, and then showcase 3 of the best dividend stocks available. The elements needed for a dividend masterpiece. In today's market, there are thousands of dividend-paying stocks to pick from, but if you zoom out and go back decades, you'll find that there is a considerably smaller list of companies that can consistently pay and increase their dividend year after year. The dividend of little over 100 corporations has been increased every year for the previous 25 years or longer. What is it about it that is so difficult? The business world is a brutally competitive environment. It's difficult for a company to maintain its position at the top of the mountain for decades at a time. The world is changing, and the economy is experiencing a cyclical pattern of recessions followed by periods of expansion. As a result, in order for a corporation to be able to pay a dividend every year and give shareholders an annual rise, the following characteristics must be present. A long-term business model that can thrive in any economic climate. One that has the ability to keep the competition at bay. Excellent financials, as well as significant profits, allow for the payment of dividends. Sometimes the answer to a difficult question is as easy as it appears. These 3 dividend stocks products are likely to be found in our own houses if we look hard enough. All 3 of them check all of the boxes on this list, and we believe they have the financial wherewithal to pay you every year for the rest of your days. Number 1. Procter Gamble, 2.5% dividend yield. If you look in your bathroom or laundry room, you will almost certainly find one of the thousands of goods manufactured by Procter & Gamble, NYSE, PG, under its 65 different brand names. Household items are sold to families all around the world by the corporation, which is a multinational conglomerate. P&G products are available for purchase by over 5 billion consumers in 180 countries through 65 brands, including Tide, Mr. Clean, Pampers, Tampax, Charmin, Bounty, Gillette, Oral-B, Head & Shoulders, Pantene, Olay, and SKII. P&G products are available for purchase by over 5 billion consumers in 180 countries through 65 brands, including Tide, Mr. Clean, Pampers, Tampax, Charmin, Bounty and Gill. P&G has purchased a number of new brands while also divesting some of its weaker ones throughout the years. While organic revenues have stayed steady, it has continually optimized its costs and repurchased shares to increase the earnings per share on the balance sheet. Between 2010 and 2020, P&G's core annual earnings per share, EPS, which reflects the company's growth from continuing operations and excludes one-time expenses, increased from $3.67 to $5.12 per share. Core earnings are expected to grow at a compound annual rate of about 9% over the next 5 years, according to analysts at Morgan Stanley. Dividend Aristocrats are members of the S&P 500 companies that have increased their dividends annually for a minimum of 25 consecutive years. In the event that they continue their record for at least 50 years, they will be known as Dividend Kings. When it comes to dividend increases, P&G is one of the most venerable members of that elite group, having done so for 64 consecutive years. The only consumer staples business that comes close to P&G's streak is Colgate-Palmolive, NYSE, CL, which has increased its dividend payout every year for 58 consecutive years, according to the company. P&G presently offers a forward dividend yield of 2.6%, which is greater than the 2.1% yield offered by Colgate-Palmolive and the 1.6% yield offered by the 10-year Treasury bond. Pampers, Tampax, Puffs, Bounty, Gillette, Crest, NyQuil, Suave, Olay, Head & Shoulders, Old Spice, Tide, and more brands are among those distributed by the company. These are goods that you most likely purchase at the grocery store on a monthly basis, frequently without giving them a second thought. During times of financial difficulty, you will most likely continue to brush your teeth and wash your clothing, but other items on your budget will most likely be the first to be cut. Consequently, Procter & Gamble has maintained remarkable stability, while increasing its dividend every year for the past 65 years. Considering that it has earned more than $15 billion in free cash flow over the previous 12 months, and has spent only half of that on dividend payments, investors should expect dividend payments to continue for years to come. Number 2. Johnson & Johnson, 2.6% dividend yield. Healthcare is one of the world's largest and most important industries, accounting for approximately 1/5 of global GDP. Our health is prioritized in the budget, and the conglomerate Johnson & Johnson, NYSE, J&J, has a significant impact on that area. In addition to being one of the world's largest pharmaceutical firms, it also has 13 medications with annual sales of $1 billion or more. There are goods for a variety of purposes, including surgery, vision care, wound care, and more, available from the company. The company's products, such as Tylenol, Motrin, Benadryl, Band-Aids, and Listerine can be found in your local drugstore if you go there. Johnson & Johnson is nearly ubiquitous in the healthcare industry. Because of its extensive influence in that industry, it has been able to consistently put money in the pockets of investors, increasing its dividend for the past 59 years in a row. Over the previous 12 months, the company has generated more than $22 billion in free cash flow, of which it spends just under half on dividends, preparing investors for years of dividend increases to come. Number 3. Clorox, 2.8% dividend yield. Returning to the realm of the domestic, we take a look at Clorox, NYSE, CLX, a conglomerate of household products that includes names such as Clorox, Pine Sol, Glad, Fresh Step, Kingsford Charcoal, and Hidden Valley Ranch, among others. Similar to Procter & Gamble, these are products that we buy on a regular basis out of habit and necessity, and the brands are strong enough that they are able to maintain strong sales despite competition from generic alternatives. In terms of market capitalization, Clorox is the smallest of the three firms discussed here, with a market worth of only $20 billion. However, it has been an amazing dividend stock, with its dividend payout increasing year after year for the previous 44 years. With free cash flow of $945 million over the past 12 months, the company has lots of room to raise its dividend payout ratio to 59%, which gives plenty of potential for future growth. It would be simple to conclude that Clorox has reached its zenith in terms of performance, NYSE, CLX. Consumer demand for cleaning goods fueled a 22% increase in revenue during the previous quarter, which lasted for the full 3-month period, but that demand spike can't be continued indefinitely. Benno Dorer, the company's CEO, is also stepping down. Linda Rendell, a seasoned executive, possesses the necessary qualifications, but any new leader will have a steep learning curve. After a year-to-date gain of 50%, it appears to be a good moment to take profits, and many shareholders did just that following the company's results report released on Monday. Is this, however, the best course of action? Investing in this company may be a good idea because it is on the cusp of undergoing another transformation. While many corporations were taken off guard by the sheer speed and depth of the COVID-19 epidemic, Clorox was able to respond rather quickly and effectively to the situation. After the virus started spreading, the most significant bottleneck was a lack of available workers. Despite this, the business's 2020 project not only was successful, but it also left the company in a strong position. However, much has changed in the previous 7 years, and Clorox has already responded to the push for innovation. It's known as Ignite, and it was officially announced at the company's Analyst Day event in October. Investors have been preoccupied with a slew of other stories and haven't paid much attention to the framework. It is, nevertheless, worth taking a look at. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.